Imagine spending 2.5 lakh crore rupees. I mean, literally burying hundreds of thousands of kilometers of fiber under Indian roads, throwing up these massive steel towers, just buying up spectrum.
Yeah, and all to give away mobile internet for basically free.
Right. It sounds like absolute financial suicide. It looks like this terrifying amount of money just going straight out the door.
Oh, absolutely. The headline numbers look terrible.
But then, in the 2019 financial year, Reliance Jio hit 300 million subscribers. And at that exact moment, they revealed this hidden wealth machine that most of the market had completely missed until it was way too late.
Yeah, that 300 million mark is the ultimate aha moment.
Welcome to the deep dive. Our mission today is to decode that hidden engine, operating leverage and capex leverage, because that Jio story, it's the perfect example.
It really is, because adding the 300 millionth and first subscriber cost Jio, well, almost zero.
Right. The heavy lifting was done.
Exactly. The machine was built. Mukesh Ambani had placed one of the largest bets a private company had ever made on a single country's digital future. And suddenly, every new rupee of revenue per user was falling almost entirely to the bottom line.
Oh, wow. So just flipped.
Completely flipped. By FY22, Jio Platform's core earnings exploded to 39,112 crore rupees, and it was quickly heading for 50,000 crore.
And all of that massive profit jump came from a fixed asset base that hadn't really changed, right?
That's the secret. The capital expenditure was done, the machine was wound up, and it was just printing cash.
Okay, let's unpack this, because if this concept is so incredibly powerful, why do the standard textbook definitions completely miss the mark?
That is the million-dollar question.
Right. And more importantly, how can you, listening right now, use this knowledge to spot these massive market shifts before the rest of the world catches on? Because I remember the definition of operating leverage from finance class.
So let me guess, the ratio of fixed costs to total costs.
Exactly. It was just a simple formula.
Which is technically correct for, passing an exam. But it is practically useless for actually investing.
Really? Why is that?
Because knowing a static ratio doesn't tell you how a business behaves in motion. The real definition, the only one that actually matters when you're trying to compound wealth, is simply the degree to which profits grow exponentially faster than revenue.
Faster than revenue. Okay, got it.
That is the entire game. Let's walk through the factory example from our sources, because the underlying arithmetic is, well, it's almost embarrassingly straightforward.
Lay it on me.
So imagine a business with 1,000 crore rupees in fixed costs. They have 40% variable margins, and they pull in 2,000 crore in revenue.
Okay, so you do the basic math, and that yields what, 800 crore in operating profit?
Exactly, 800 crore.
Okay, that makes sense. But wait, before we throw too much financial terminology around, because I know we're going to be talking about profits a lot today.
Sure, yeah.
When we say operating profit, or EBITDA, for those of us who don't spend our weekends building financial models, that's just earnings before interest, taxes, depreciation, and amortization, right?
Yep, that's the one.
It's basically the raw cash a business makes from its core operations before the accountants get their hands on it.
That is the perfect way to look at it. It's the pure operational cash engine of the business.
Okay, cool. So back to the factory, 800 crore profit.
Right. Now watch what happens to that engine when demand picks up. Let's say that factory's revenue grows by just 25%. So that takes it to 2,500 crore.
Okay, revenue is up 25%.
But because those massive fixed costs, that initial 1,000 crore, they do not move an inch, the operating profit doesn't just grow by 25%.
Wait, what does it do?
It leaps to 1,300 crore. So your revenue grew 25%, but your pure operating profit just grew 62.5%.
Oh, wow. That is a massive difference.
It is. That widening gap, between how fast the top line moves and how violently the bottom line follows, that is the secret engine.
It's like renting a massive venue for a party.
Right.
Like once the DJ and the room are paid for, every extra ticket you sell is just pure profit.
That's a great analogy.
But wait, building that venue or the factory or the telecom network, that takes years. And it absolutely ruins your bank account in the short term, right? Like it looks terrible on paper to anyone watching.
Right. And what's fascinating here is that this exact dynamic creates a massive blind spot. Our sources call it capex leverage.
Capex leverage, yeah.
Okay. When a company deploys huge capital to build a fixed cost base, like a giant oil refinery, a semiconductor fab, a hyperscale data center, the financial returns look awful for years.
Because the asset is just sitting there, right, underutilized.
Exactly. The return on capital employed, the ROCE, is really low. and it's usually falling as they pour more and more money into the ground.
So most investors probably look at those terrible headline numbers, assume the company is just burning cash, and move on.
They do, they completely write it off. But the true signal is the inflection point. It's that very quiet moment when the factory is finally built and incremental revenue starts requiring zero new capital.
Ah, so the ROCE stops falling and starts rising.
Yes, very quietly, usually buried deep in the footnotes, and the broader market usually takes like 4 to 6 quarters to even notice it's happening.
Which gives you a massive window of opportunity if you know what you're looking for.
Exactly.
Okay, so this party venue analogy, or the bridge analogy, works for a digital network like Jio. But what about physical heavy BERT?
Oh, it absolutely applies there too.
Because looking at the landscape right now, in 2026, we are seeing this exact math play out across three very different arenas. Let's start with Indian cement.
Sure.
People think of cement as this boring, linear commodity, but you need limestone mines, massive kilns, freight networks, captive power plants.
Fixed costs are staggering.
Right. And Ultratech cement is the perfect example here. Despite intense industry pricing pressures, they crossed 200 million tons per annum in capacity in FY26.
Yeah, and their Q3 FY26 numbers are an absolute masterclass in structural operating leverage. Let's actually look at the math.
Let's do it.
So their revenue grew 22.5% that quarter. But their core operating profit, that EBITDA we defined earlier, grew 35.3%.
Wow, 35.3.
Yeah, that pushed their core profit per ton of cement from 911 rupees up to 1,051 rupees. They achieved nearly a 15% per unit gain in a brutally tough pricing environment.
Just because the volume grew, right? So the colossal fixed costs of those kilns and mines were simply absorbed.
Exactly. Our sources note that when an industry's overall utilization pushes past 80 to 85%, the companies sitting on the largest fixed cost bases just benefit completely disproportionately.
Okay, so that proves it works with physical heavy industry. But what happens when your fixed cost isn't a limestone mine, but literally the most complex technological environment on Earth?
You mean semiconductors?
Yes. Semiconductors where the math is just brutal. Building a single leading-edge fab today costs, what, $15 to $20 billion?
At least. The fixed costs are astronomical.
Yeah.
You've got the depreciation on the machines, the R&D, maintaining these pristine clean rooms.
But then you look at TSMC's Q1 2026 results. Their revenue hit $35.9 billion, which is up 40.6% year over year. But their operating margins, they reached an astounding 58.1%.
Which is just wild. When a TSMC fab runs at over 90% utilization, churning out 3-nanometer and 2-nanometer chips that absolutely no one else on the planet can replicate, the marginal economics become extraordinary.
So they just print money at that point.
Basically, their operating margin was 9.6 percentage points higher than just a year prior. It is extreme scale in action.
Because the heavy lifting of the R&D and the cleanroom construction is already paid for.
Right. It's done.
Wait, speaking of heavy lifting, let's talk about Fart Electronics, or BEL. Because when I think of exponential tech-like compounding, a legacy government defense contractor is literally the last thing on my mind.
Yeah, it surprises a lot of people.
How does that math work for them?
Well, BL spent the better part of a decade quietly building engineering talent, massive manufacturing lines, and highly specialized test infrastructure.
Which are all fixed costs.
Right, essentially permanent fixed costs. Now, as the Indian defense budget rapidly expands and, indigenization takes hold, every rupee of incremental revenue flows straight past those fixed costs.
And straight into operating profit.
Exactly. In Q3 FY26, they were operating at a staggering EBITDA margin of 29.7%.
Wow.
But the real kicker is their order book. As of July 2025, it stood at 74,859 crore rupees.
Almost 75,000 crore. That's insane.
It gives them nearly 3 years of guaranteed revenue visibility against a fixed base that absolutely does not need to scale proportionally with those new orders.
Okay, here's where it gets really interesting. If TSMC's margins are public, and BL's massive 75,000 crore order book is sitting right there in a press release for literally any retail investor to read, why doesn't the market immediately price this in?
That is the big question.
Why does that 4 to 6 quarter lag even exist?
It fundamentally comes down to human psychology and really how the financial industry is trained to build spreadsheet models.
What do you mean?
Well, analysts are taught to linearly extrapolate. If a company grew at 10% last year, they plug in 10% or maybe 12% for next year. They structurally struggle to account for exponential math.
Ah, so they just draw a straight line.
Exactly. When they see a company spending heavily on a new factory, they model in the heavy depreciation and they assume margins will stay suppressed for years.
So they fundamentally miss the inflection point, that moment where the fixed costs are fully absorbed and profit growth suddenly completely decouples from revenue growth.
Yes, they completely miss it until it slaps them in the face.
Okay, so if the professional analysts are that slow to react, how can you, the listener, actively track these indicators before the headlines hit? Because, I mean, waiting for the analyst upgrade is a losing game.
Absolutely. You have to look at the leading indicators.
And our sources lay out a 4-metric framework for the investor toolkit to spot this leverage early. Let's break these down because I don't want this to just be a list. I want to know exactly how this works on a balance sheet.
Sure.
So the first metric is tracking the capacity utilization trend.
Right. You were looking for the migration from, say, 65% utilization up to 80% utilization.
But where do I find that? Because it's almost never in the flashy headline earnings release, right?
No, almost never. You have to dig into the quarterly investor presentation decks. It's hiding in plain sight. If you only read the headline revenue numbers, you miss the unit economics quietly transforming in the background.
Got it. Okay, the second metric is the divergence between EBITDA margin and revenue growth.
Yeah. Remember the Ultratech example?
Right, where revenue grew, but profits grew way faster.
Exactly. If revenue is growing at 15%, but core operating profit is growing at 30%, the leverage machine is firing. And that divergence can persist for 6 to 10 quarters before the broader market fully catches up and adjusts the stock price.
Hold on, let's visualize the third metric, the asset turnover trajectory. If I'm looking at a company's balance sheet, what am I literally looking for? Just a flat line on the assets page and a spike line on the revenue page?
Essentially, yes. You simply divide total revenue by total assets.
Okay.
If you see that ratio rising steadily against a relatively flat fixed asset base, it mechanically means the company is generating new sales without having to pour proportionate new capital into the ground.
So the machine is running entirely on its own momentum.
Yes, exactly.
And then we get to the fourth metric, which the sources call the most powerful signal of all, incremental ROCE.
Return on capital employed, but calculated only on the change in capital versus the change in operating profit.
It's like looking at a car's tachometer instead of just the speedometer, right? Like the speedometer tells you how fast the car is moving right now, but the tachometer tells you how hard the engine is working to get there.
That is a brilliant way to put it. Incremental ROCE tells you the exact return on the very next dollar you invest.
But, okay, stop. I'm looking at this incremental ROCE math, and frankly, nobody listening to this has the time to sit and calculate this quarter over quarter for 50 different companies.
Oh, I know. It's tedious.
Tell me there's a shortcut. Can't I just look at a standard PE ratio to see if the stock is cheap?
I am so glad you asked that because relying on the PE ratio in these specific scenarios is one of the most dangerous traps you can fall into.
Really? Why?
The price-to-earnings ratio is a terrible, highly distorted metric for any company undergoing massive CapEx. During the heavy build-out phase, accounting rules force the company to take heavy depreciation charges, to reflect the cost of the asset over time.
Okay, yeah.
That depreciation is a non-cash expense, but it artificially crushes the reported net profit on paper.
Which means the E in the PE ratio shrinks,
Right.
making the stock look incredibly expensive, right?
Exactly. If you've ever looked at a stock, saw the PE ratio was sky high, decided not to buy it, and then watched it double over the next 2 years.
Never.
This is exactly why that happened.
Wow, you were looking at the wrong dial.
You were.
So wait, why does stripping out depreciation via the EV to EBITDA multiple suddenly give us the honest picture?
Well, EV to EBITDA looks at the enterprise value against the pure operating cash flow, that EBITDA we talked about earlier. By stripping out the depreciation distortion, it shows you the actual cash the underlying asset is generating.
Ah, so it removes the accounting illusion.
Right. But even with the right metric, you still have to know exactly where you are in the cycle. Paying 12 times EV to EBITDA at the trough of a CapEx cycle, right before utilization ramps up and margins expand, brilliant investing.
But paying that same 12 times at the absolute peak of a
This
cycle,
is an absolute disaster.
which leads perfectly into the value traps that destroy even smart investors, because it's not just about finding leverage, right? It's about making sure the leverage is actually real.
Yes. The sources dive deep into the cyclical versus structural trap, and the 2020 to 2022 Indian steel boom is the ultimate cautionary tale here.
What happened there?
So, during that massive post-pandemic steel boom, Indian steel companies showed breathtaking margin expansion.
Everyone was making money.
Hand over fist. Investors looked at their screens, thought, wow, look at this operating leverage. And they paid structural, long-term tech multiples for dirt cheap steel stocks.
But they misread it.
They fundamentally misread the math. The margins were expanding entirely because of commodity price spreads, the temporary gap between cheap input costs and sky-high selling prices.
Ah, it had nothing to do with increased volume pushing through a fixed cost base.
Exactly. It was a cyclical mirage tied to global commodities. When those price spreads inevitably normalized, the margins completely collapsed.
And those expensive stock multiples just vanished overnight.
Poof, gone. True structural leverage must be driven by volume and product mix, never just by pricing.
The distinction between volume and price is so critical, and there's another trap that caught a massive amount of people recently, right? The proxy investing trap or the shadow beneficiary.
Yeah, this one is classic.
Everyone saw the massive data center and AI boom coming. It was incredibly obvious.
Yeah.
Instead of buying the hyperscale operators, some investors bought the cooling equipment suppliers or the fiber cable manufacturers.
Thinking they were being clever by buying the picks and shovels.
Exactly. But that was a mistake, wasn't it?
It was, because it represents a fundamental misunderstanding of the exponential math we're discussing today. Yes, those equipment suppliers had a massive demand tailwind. Their revenue absolutely grew.
On it.
But they experienced linear growth, not exponential. Every single time they sold a new commercial cooling unit, it required proportionate new labor, new raw materials, and new factory space to build it.
Oh, so they had no massive fixed cost base to leverage?
Not at all. There's no magical inflection point where the 1,000th cooling unit cost them zero to manufacture. The market priced them for exponential compounding, but their underlying physical business model only allowed for a straight, linear line.
If we connect this to the bigger picture, mistaking a cyclical mirage or a linear proxy for genuine structural leverage is arguably the single most expensive lesson you can learn in the market.
Without a doubt.
You have to know what kind of machine you are actually buying. Which brings us to the ultimate macro application of this entire theory from our sources. The reason this deeply matters right now is because of what is happening in India in 2026.
Yes. India is currently executing something unprecedented at this specific scale.
Tell me more.
The entire country is simultaneously building massive fixed-cost infrastructure across multiple sectors of the economy. We are looking at enormous new airports being built by GMR and Adani, pouring billions of dollars into physical capacity that will take years to fully fill.
Huge fixed costs.
Right. We are looking at massive interconnected toll road networks. And crucially, we are seeing the massive impact of PLI-driven manufacturing.
Just to clarify for the listener, PLI, production-linked incentives, is where the government is basically subsidizing these companies with cash payouts to build out massive local manufacturing capacity, right? In sectors like electronics, solar, and defense.
Correct. The government is directly incentivizing the creation of the fixed cost base. Right now, many of these brand new massive facilities are sitting at 50 to 60% utilization.
Which means?
They're exactly where Reliance Jio was right before it hit that critical subscriber mass. The fixed cost base is fully constructed today. And when that utilization inevitably moves from 60% to 80% or 90%.
The sudden earnings surprises are going to completely break the linear spreadsheet models that analysts are currently using.
Exactly. The analysts won't know what hit them.
But, and this is a massive but, our sources make it abundantly clear that not all operating leverage is created equal. What separates the true compounders, the companies that grow wealth for a decade straight from the one-cycle wonders who just fizzle out?
It all comes down to the defensibility of the moat.
The moat.
Right. Leverage gets competed away brutally fast if the fixed cost base is easy for someone else to replicate. Think about TSMC again. Their fixed cost base is highly defensible because the complex physics and technology running inside that $20 billion fab is nearly impossible for a competitor to replicate on any timeline that actually matters.
Wow, yeah. Or look at Amazon AWS.
Yeah.
In just the fourth quarter of 2025, AWS generated $12.47 billion in operating income.
Huge numbers.
Why is their leverage so protected? Because the switching costs are enormous. It costs an enterprise customer 6 to 12 months of pure engineering pain and millions of dollars to untangle their infrastructure and move off AWS.
Exactly. That is a massive moat.
And compared to that, you have Ultratech Cement, where the moat is decades-old local dealer networks and highly regulated limestone leases that a new competitor simply cannot acquire overnight, no matter how much money they have.
Right. On the flip side, what's a weak moat? A greenfield toll road with an alternate route, or an easily replicated solar module factory.
Because if anyone with a big enough bank loan can build the exact same factory right next door to yours,
your operating leverage will vanish as soon as it appears. The new supply will flood the market and just crush prices.
So what does this all mean? It means the real moat isn't the product you sell. The moat is the sheer capital expense, the regulatory nightmares, or the extreme technological pain required for a competitor to replicate the underlying asset you've already built.
Brilliantly said. When you have structural secular demand, a high fixed cost base rapidly approaching that utilization inflection point, and an impenetrable moat that keeps competition at bay.
That's the sweet spot.
That is when you have the exact setup for the kind of wealth compounding that quietly bewilders everyone who missed it.
It is a completely different way of looking at the market. So let's recap the journey we've been on today. We started by throwing out the rigid textbook definition of operating leverage and replacing it with the dynamic truth, right? It's a financial machine where profits grow exponentially faster than revenue.
Exactly.
We learned how to spot it early by ignoring the speedometer and watching the tachometer, looking for that incremental ROCE on the balance sheet.
Watch the engine, not just the speed.
We saw exactly how to avoid the cyclical traps like the commodity steel boom and the linear traps like those data center cooling stocks. And finally, we looked at how unreplicable moats, whether it's a TSMC cleanroom or an Ultratech limestone mine, are the only true way to protect that leverage once the machine actually fires.
The overarching takeaway from all our sources is that while the rest of the market is endlessly fixated on short-term earnings beats, and quarter-to-quarter media noise.
Which is exhausting.
Truly.
Right.
But understanding this underlying structural math allows you to quietly compound wealth.
It really does.
But this raises an important question, one that our source text leaves us to ponder. Right now, tech giants like Amazon and TSMC are heavily doubling their capex.
Doubling it.
Yes. TSMC alone committed a staggering $41 billion in 2025, building complex fabs in significantly higher cost geographic areas like Arizona and Japan. And this extreme spending is temporarily compressing their current margins.
Which, as we learned today, mechanically makes them look significantly less profitable right now on paper.
Right. But are these tech titans deliberately sacrificing today's margins simply to build tomorrow's permanent fixed cost base?
Oh, wow.
Are they intentionally making themselves look slightly weaker to Wall Street right now, absorbing massive short-term pain in order to construct an impenetrable exponential operating leverage mode that absolutely no competitor on Earth will be able to touch by 2030?
Wow. It's like they are building a toll bridge so massive, so expensive, and so technologically advanced that no one else can even afford to lay the first brick in their city ever again. It's a fascinating thought to leave on. Thank you for joining us on this deep dive. Keep looking past the headlines, start digging into the footnotes for those utilization rates, and the next time you see a company destroying its short-term bank account to build something massive, remember the math. Until next time.